What is credit score and how it works? This is just about everything you need to know about credit scores. Hello and welcome to B.L.D, where you get the information you need to understand and succeed with money. If you're new to credit scores or just want to enhance your knowledge, then you're in the right place. This video is going to be broken up into different segments, like what is a credit score, FICO credit score model, how credit scores work, how credit scores are calculated, how to check your credit score, factors that affect your credit scores, and for those of you who stick around until the very end, I'll let you know the secrets that'll help you achieve a high credit score with very little effort in a short period of time. So without further ado, let's get started. What is a credit score? A credit score is a 3-digit number, usually on a scale of 300 to 850, that estimates how likely you are to repay borrowed money and pay bills. Credit scores are calculated from information about your credit accounts. That data is gathered by credit reporting agencies, also called credit bureaus, and compiled into your credit reports. The three largest bureaus are Equifax, Experian, and TransUnion. You don't have a single credit score, you have a few, and they probably vary slightly. The highest credit score that you can get is 850, although there's not much of a difference between a perfect score and an excellent score when it comes to rates and products you qualify for. There are two most widely used models of credit score. First one is FICO score model and the second is Vantage score model. FICO score model is the most widely used model of credit score, so let's have a look over it. FICO credit score model. The FICO credit score was first developed in 1989 by Fair Isaac and Company, now called the Fair Isaac Corporation. According to MyFICO, over 90% of top lenders use FICO credit scores to make lending decisions. FICO offers many different types of credit scores. If you're taking out an auto loan, for example, a lender might check your FICO auto score. If you're applying for a credit card, a lender might look at your FICO bank card score. If you don't have much of a credit history yet, you can sign up for an Ultra FICO to have your banking activity factored into your credit score. FICO regularly updates its credit scoring models to reflect changes in the industry and provide a more nuanced perspective of an individual's credit worthiness, although these models can take some time to roll out. FICO recently released the FICO Score 10 Suite, for example, but the FICO Score 8 model is still the most widely used FICO credit score. There are 5 general ranges of credit score. Excellent credit ranges from 800 to 850. Very good credit score ranges from 740 to 799. Good credit score ranges from 670 to 739. Fair credit score ranges from 580 to 669. And poor credit score ranges from 300 to 579. How do credit scores work? A credit score can significantly affect your financial life. It plays a key role in a lender's decision to offer you credit. Lenders are more likely to approve you for loans when you have a higher credit score, and are more likely to decline your loan applications when you have lower scores. You can also get better interest rates when you have higher credit scores, which can save you money in the long term. Conversely, a credit score of 700 or higher is generally viewed positively by lenders, and may result in a lower interest rate. Scores greater than 800 are considered excellent, and every creditor defines its own range for credit scores and its own criteria for lending. So how is your credit score calculated? Your FICO credit score is calculated based on 5 factors, which are 35% payment history, 30% of amount available credit used, 15% of length of credit history, 10% new credit, and 10% of types of credit. How can you check your credit score? There are many different ways to check your credit score. Many banks and credit card issuers provide free credit scores to account holders. And apps like CreditWise from Capital One, Discover Credit Scorecard, Identity Force, Mint, Identity Guard, MyFICO, Experian, Equifax, and TransUnion will let you check your credit score. You can also sign up for a credit monitoring service. These services not only give you updated credit score information, but also check your credit report for potential signs of identity theft. Some credit monitoring options are free, while others come with a monthly or annual subscription cost. You might even be able to access your credit score through a budget tracking app. Now let's talk about factors that affect your credit scores. Number 1 is payment history. Payment history makes up the biggest chunk of your credit scores. That's why it's so important to make on-time payments each month if at all possible. Late payments can haunt your credit history for up to 7 years. Number 2, credit usage. Credit usage or credit utilization is another important factor. This measures how much of your available credit you tap into at any given time. experts recommend that you keep this to less than 30%. Number 3 is credit history length. The length of your credit history has some impact on your credit, though not much. This factors in the age of your oldest and newest credit card accounts, as well as the average age of all your accounts. The older your credit, the better, because it shows lenders that you have more experience managing credit. Number 4, credit mix. Your credit mix has a small impact on your credit. This looks at the type of credit you borrow. Lenders want to see that you can balance revolving accounts like credit cards with installment accounts like mortgages, student loans, auto loans, and personal loans. Number 5, recent credit. Your recent credit also has a small impact on your credit. This tracks the applications you file for things like new credit cards and personal loans with hard inquiries. The fewer, the better. Next, let's talk about how to increase your credit score. Number 1 is paying your bills on time. Your payment history makes up the largest part of your credit score, which accounts for 35%. Even small slip-ups can lower your score by a lot. Late or missed payments stay on your credit report. It can affect your credit score for up to 7 years, as we mentioned earlier. Always make at least the minimum payment by the due date. You can set up payment reminders and automatic payments within your accounts so you never accidentally miss a due date. Just make sure you have enough money in your accounts to cover your bills. Also, check your credit reports at least once a year and correct any inaccurate information. Number 2, keep your balances low. The second most important factor in determining your credit score is how much of your available credit you're using. That's called the credit utilization rate. If the rate is high, meaning you're closer to hitting your credit limits, lenders may view you as more likely to default. Having credit cards and using them isn't a bad thing, but it's important to keep your debt manageable. The best practice is to pay your credit card bills in full every month. If you can't, pay as much as possible. Try to keep your credit card utilization rate below 30%. That means that if you have a credit card with a $10,000 limit, the balance should be less than $3,000. Also, make sure you understand how credit limits work. Number 3, don't close old accounts. Your score considers the length of your credit history, along with the ages of your different accounts. In general, a longer credit history means a higher score. If you close those old cards, you're lowering the average age of your account. When you last used your cards is another factor in your score. Even if you intend to keep an old account, your credit card issuer may close it if it hasn't been used for a long time. Keep older credit cards active, even if you don't need them. Consider putting small, reoccurring purchases on them, such as streaming service subscriptions. Then set up payment reminders or automatic payments to make sure you pay off the balances on time. Also, think twice before opening new accounts, since they lower your average account age. Number 4, have a mix of loans. Lenders like to see that you can manage multiple loans at the same time. In general, it's good to have a mix of credit cards and installment loans, such as a mortgage, an auto loan, and student loans that you pay on time. This is a relatively small part of a credit score, so it probably isn't effective to open new accounts to just try and pump up your score. But know what types of loans you have, and consider improving the mix the next time you need to borrow money. Number 5, think before taking on new credit. Getting a new credit card can both help and hurt your credit score, so it's important to be strategic. Research shows that people who open several credit accounts in a short period may be higher credit risk than those who don't, according to FICO, the leading credit score provider. When you apply for a new credit card, your credit score can fall initially because the lender looks at your credit report, known as a hard credit check, and the average age of your accounts is lower. Open new accounts sparingly and avoid doing it at all if you're about to seek a mortgage or other major loans. If you get a new credit card, try not to use it too much. That way, you're using less of your available credit, which could improve your credit health. And if your credit history is limited, a new card could help improve your score, as long as you pay it on time and don't take on too much debt. Thanks for watching. Share your opinions in the comments section. If you found this video helpful, hit the like button, subscribe to the channel, and press the bell icon to get instant notifications of upcoming financial videos.